Good afternoon, everyone, or good morning for some. Thank you for joining us. I'm Philip Nelson, joined by my colleague Jennifer Pell. We're going to talk the next half hour or so about the election results and more so kind of our thoughts on how the election's impacting the markets, both last few days, but also kind of what we're seeing into 2025 and beyond. So just in terms of kind of the focus here, we've done an election webinar 3 election cycles in a row now. I think we've been surprised in a different form each time. I think this time we were surprised the fact that we knew more or less the results by Wednesday morning. But I think, again, we're not going to pretend to be political experts. We're going to assume most of you are getting kind of your analysis, political news, to kind of various kind of experts and sources. And the assumption we're running with is, even though there's some open house races still yet to be called, it looks like you'll have Republicans controlling Congress and the presidency, obviously, slim majority likely to see in the House, which may impact some of the legislative agenda. Nevertheless, we're going to go with that assumption, based on some of the results we're seeing already. So, with today, we're going to try to take some questions, so feel free to drop questions into the chat box. We're not going to have any slides. It's going to be more of an interactive discussion. So you'll see Jen and I ad-lib a little bit and hopefully provide both an informative and entertaining next 30 minutes. But as we get started, why don't we take a few minutes, Jen, and just talk about what are some kind of the recent market moves, recent market actions over the last few days?
Sure. Yeah, and I think one of the points you mentioned up front, that we didn't know if we were going to know the results the day of the election. That was kind of a key point for many of us, and part of the reason actually that we pushed our election webinar a couple days, because we weren't sure if we needed a few days of buffer time for the results to come in. But I think that underpinned some of the market moves that we saw in the days following the election, because everyone was positioned for some type of uncertainty, because there was almost this kind of binary policy outcome, because the polls were pretty close going into it. National polls, swing state polls, everything was close. So there was, in some sense, kind of some hedging for election or political uncertainty that was taking place in markets. And I think the day of the election, when there was a little bit more certainty, a lot of that had to unwind, so you saw some of that coming off. In addition, you saw a little bit of a Trump trade flowing through when that became clear that he was victorious in the election. And Trump trade, I think, gets thrown out there as a pretty common phrase now. What I mean at a really simplistic level there is equities were up, bond yields were up, and the dollar was up. So that is probably the most basic way to say it. There were so many different variations within there. We saw the bond market moving even ahead of the actual election results, which is pretty different than what we saw in 2016, where maybe we were surprised, like you said, in a little bit different way. But I think the equity side was probably the more interesting piece of it, where some of the policy aspects were flowing through in terms of small caps or financials. You saw those rally quite a bit. There were also some maybe oddities that I would call in Bitcoin or Tesla, or some of those individual names that started rallying, which is a little bit different than usual. But there were a lot of different things happening at the same time, but pretty positive risk-on environment for markets.
When, as you kind of peel back the layer in some of this, you could argue, what we saw kind of Wednesday or kind of overseas markets Tuesday night, a little bit of almost kind of short covering. There's plenty of folks out there, that thought there would be, maybe a prolonged time period before we know the results, and so market abhors uncertainty. And so in some ways, a typical short covering activity, you'll see, see kind of selling down of treasuries. You see a buyback in Russell 2000 small caps. That's a typical lever that one will pull to kind of easily short the market. So quick snap rally in small caps, they were up quite a bit. Treasuries rallying a little bit, has the feel of a short coverage, but also when you get down into some of the underlying data, and we'll talk a little bit about this in a bit, just thinking about kind of the regulatory backdrop. but financials, for example, rallied a huge amount. So there are those aspects of what you were saying, kind of looking to what are some of the things that a Trump administration may be more friendly for certain areas of the markets. Yeah. With that, we're going to spend some time talking about kind of what we're seeing is kind of 5 key kind of themes that we think we're focused on in terms of what are some of the policies we'll see from the Trump administration. We'll try to take a couple minutes on each of those. And again, if you have questions, feel free to fire away, and we'll try to answer them either at the end or in real time if relevant. But I think first and foremost, what's on most folks' minds is trade policy. So I think it's likely that we will see, or more than likely, we'll see some form of tariffs come in place relatively quickly when Donald Trump assumes power in January. And these may be kind of broad-based tariffs on kind of imports coming into the U.S. 5 to 10% range is some things that we've read. Certainly, tariffs on higher tariffs on Chinese imports are likely coming as well. Jen, can you talk a little bit about almost the latitude that kind of the executive branch has to levy tariffs relative to a lot of these don't require congressional action?
Yeah, I think that's probably the key point relative to a few of the other items that we're going to walk through today, that a lot of these can actually be enacted in pretty short order. So there is latitude to do this without Congress's approval. So a little bit different on that front. And, I think when we talk about tariffs in general, there is this thought that, okay, it is going to be very negative for the economy, for markets. And maybe we can talk through that just a little bit, because essentially everything you read out there is like, okay, tariffs are going to be negative for growth, positive for inflation. So can we maybe have you comment on that piece a little bit?
Yeah, I mean, it's interesting. So I think, common thought is tariffs are by definition inflationary. Well, from a price standpoint, yes, the price of goods goes up. But I think what we've seen under the last 8 years or so, tariffs didn't necessarily lead to kind of inflationary tailwinds. What you do see is prices move up. That's captured in a CPI index over a 12-month period. But then they roll off at kind of month 13. Another example to think of, tariffs or kind of changes in prices, as you look back at Japan and some of the economic controls and economic stimulus they tried to put in place, working through kind of the low inflation periods of kind of the last 20 years, they would increase sales tax. Some of that with the intent of increasing prices, but all that essentially really did was be a bit of a headwind on consumption. It had zero, if anything, maybe a slight negative impact on inflation. And I think as we're thinking about kind of the impact of tariffs, tariffs from purely a price change, we think are relatively muted. It's a bit of a headwind to consumption, but I think altogether, many of the policies we're likely to see in the Trump administration are positive for nominal growth. So likely offsetting any sort of kind of negative consumer consequences. And I think what's probably most critical is kind of draw a distinction of when do tariffs become somewhat destructive to economic growth. And I think this is where more of if there's limits placed on goods moving between countries. So think, auto parts or any sort of widget that is integrated in the global supply chain. To the extent that those are inhibited, that's where you start to see disruptions. If you disrupt the supply chain, then you do start to see real economic impacts. And I think that's a tail risk that I think is a low probability event. But the tariffs are definitely coming.
Yeah, and that's why I think the tariff conversation is so interesting too, because it's not binary. Most things aren't, but when we talk about tariffs, there are a lot of response mechanisms that countries can have too, in terms of currencies or capacity constraints that they can implement to respond to tariffs, or we could see retaliation. So there are so many other factors that can influence how impactful tariffs can be for economies that I think we just don't know at this point.
Well, that's true also for China. Is you think about what is the extent of the impact on China for higher levies and higher tariffs put in place. So kind of 5 to 10% has been floated around as a potential levy on all goods coming into the U.S. And we may see higher levels for countries that run a higher trade surplus with the United States. So China, Germany, two biggest trade surpluses. There's two of the bigger trade surpluses out there. So they may have a more unique tariff structure put in place. But at the same time, for China, there's a couple underlying aspects going on. From a supply standpoint, many areas of the economy in China are running above long-term averages in terms of exports. And a cynical argument can be made that that's intentionally being done, feeding into future negotiations that may take place in terms of trade negotiations between China and the U.S. But then also, if you raise prices 50%, and you have other policies that are pro-nominal growth for the U.S., it's probably likely a strong dollar. So that already makes the goods coming in the country a little bit cheaper because of the currency. And the extent that China is able to both either reduce production and or also weaken the currency, kind of takes a little bit of a cushion in terms of tariffs that could be put in place. So I think there's a lot of headlines we're going to see on tariffs, but I think of all the things out there, this is probably the least of our concerns. Probably, is that fair?
Yep, agreed.
Yep. We are getting some questions in. Unfortunately, I didn't bring my glasses, so I can't see that closely. So I'm going to lean in really quickly and kind of go through the questions. And again, there's no slides today, so all you should be seeing is just Jen and I in terms of the deck. So hopefully that's the case. Hopefully that's the case for everyone. Then when we think about some of the other aspects of kind of themes that we're thinking about, this may be a little more longer tenured, but can you talk a little bit about immigration policy? And when we talk immigration policy, we are more focused on the labor market and not necessarily kind of other aspects of immigration that are clearly been kind of a more heightened political commentary these days.
Yeah, and I think immigration overall was a pretty clear hallmark of Trump's first term. So we have some clear direction, I think, on the way that policy is going to move. So from more of an economic or market perspective, it's reasonable to expect that the tailwinds that we had for the labor market in terms of net immigration flows that supported the labor supply over the last few years, that tailwind is going to be slowing moving forward. So when you think about what does that mean going forward, we were saying for the last few years that the labor market was really the key to the economy because that was driving a lot of the consumption story, the headline economic growth numbers, and so forth. And if that labor market story changes, or if the labor supply story changes, there could be wage pressures that come from that.
Yep.
There could be not enough workers to fill the jobs that are out there. So there could be some shortages of labor in certain pockets of the economy that can create disruptions.
Yeah.
So there are some real risks I think that poses, and you kind of take that out over a longer term time horizon. It may not be a shock to inflation next year, but it could be a slower uptick in inflation that has some momentum to it.
Yeah, and I think it's important to emphasize it's not just kind of maybe lower income or lower skilled areas of the workforce. This is widespread, from the tech sector to kind of other areas that you could see some of that kind of impact, flowing through. And as we think about, some of the policy changes that we're likely to see, what are some thoughts as this issue evolves in the next 12 months, things that would surprise you? What are some things out there that maybe non-intuitive that people aren't thinking about that's something would be good to bring to light?
Yeah, maybe on the non-intuitive part, there are two kind of structural aspects that I think we maybe haven't given credit to when we're talking about the labor market. One being the demographic profile of the U.S. and how this feed into labor supply has really helped to offset the demographic headwinds that are at play today. And second, since COVID, we have had a lower labor force participation rate. So again, that uptick in labor supply has really kind of masked any underlying weakness that could be there.
Well, just demographically, that kind of workforce participation is going to be coming down. It's less of an issue for the U.S. relative to the rest of the globe, especially China. And so some form of net kind of migration is a positive for workforce participation over the long term, I would say.
And on the surprises side, I think it comes back to the wage inflation piece. Again, if we have disruptions that create a bigger momentum in wage inflation, that creates a bigger issue for the Fed to have to deal with. And then the market has to reprice that path for Fed funds moving forward. And we could be dealing with some upside in rates, which is not priced in today.
Why don't we pivot, Jen, and talk a little bit about the regulatory framework. Maybe to kind of steal a comment from you, one thing that we observed in the election in 2016, the immediate 2 weeks after Trump won, the small business survey took a dramatic uptick higher. So there had been a fair amount of kind of concern about kind of small businesses and kind of confidence in the U.S. And that moved up quite a bit. And you look again today, small business survey, expectations are pretty muted. And could we see something similar to that? Maybe just talk a little bit about kind of the regulatory framework and the regulatory burden, how things may change over the next year or so.
Yeah, that small business optimism survey I know is one of my favorite things to talk about. But what's interesting, you look at some of the underlying components of that too. It's not just small business optimism. It's hiring plans went up. It's capital expenditure plans increased. So it is just such a boon to small businesses in a really prolific way. And you think about why is that the case? This can be very onerous, the regulatory backdrop for small businesses in terms of costs and also just needing to spend time and effort on complying with these regulations. So if these regulations start to peel back a little bit, that is a positive and can end up actually helping earnings if there's not quite as many costs associated with it. So I think that's the bottom line from a market's perspective, and part of the reason why we saw small caps move so much the last few days. One of the quotes that really stuck out to me over the campaign trail, there was some comment from President-elect Trump about wanting to remove something like 10 old regulations for every new regulation he enacts. So, it just speaks to this bias to really move away from a more stringent regulatory environment. So that really can work to the advantage of certain industries where that's a big deal, like financials, like energy, and others. And I think we're going to see certain sectors really reacting to that in equity markets.
Yeah, and I think one thing that's kind of also important to emphasize is small businesses are the majority of the job engine in this country. And part of what you'll hear is there is a tilt under what we are likely to see from the Trump administration to kind of more pro-nominal growth initiatives, and also probably a slightly higher inflation tilt as well. But you look at some of these things and coincide with reduced regulatory burden. The Fed cut rates yesterday. For any entity that's borrowing funds at a floating rate, their interest cost is coming down. Regulatory burden eases. You start to get room for more hiring, and what's already in a pretty good economy, which is fair to say. Two other kind of important areas that we want to focus on. And first, we'll talk about kind of tax and fiscal policy. I think as we look at tax policy coming into January when Congress opens, we likely to see tax cuts be kind of priority number one. I think it's fair to say. To what extent and to what speed can those be put into place I think was a question mark related to the margins of the differentials we're likely to see for the Republicans in the House. That said, there's going to be a push to maintain current tax rates, which expire at the end of 2025. And also especially acute again on small businesses, which many are pass-through entities that will feel that tax rate hike if that doesn't happen. And then two, there will be ongoing discussions about corporate tax rates. And to what degree is the market price some of this in? It's hard to say. Kind of general enthusiasm of kind of the market in the last few days. Maybe some of it's expecting a tax cut. I think when we look at kind of some different estimates out there, reducing the corporate tax rate maybe adds 3 to 5% to the markets in terms of potential gains from just kind of the earnings flow through based on kind of current PE multiples. So you can argue that's probably already priced in, especially with an already kind of somewhat frothy kind of equity market.
And Phil, when we talk about tax policy, I think, sometimes we talk about, okay, that is the revenue that the government is going to take in.
Yep.
I want to flip it to the other side of the equation and talk about the spending piece, because that is, I think, going to be part of the tax conversation. So maybe can you talk about how could they even think about lowering taxes if the deficit is such an issue?
Yeah, and and that is a question mark. I think we get this from many of our clients. How concerned should we be about the deficit? And I think we try not to be flippant about it, but the realistic answer is the market's not very concerned, and you see it in terms of kind of the bond market pricing. The bond market's more concerned about inflation. I think they're less concerned about kind of current spending. So 6% kind of deficits as a percent of fiscal deficits, the percent of GDP, likely to continue, maybe a bit higher with tax cuts coming in future years. And there's different metrics one can use. The short answer is, in a world with higher nominal growth and above average inflation or just slightly higher inflation, it's easier to pay your debts. It's easier to pay your interest expense. All of that flows through and makes the world a lot easier. If we look back to the big sovereign debt crisis of the last 20 years, what we saw in Europe 10, 15 years ago is deflation is the real risk of what causes an issue with kind of fiscal deficits or high debt to GDP levels. That doesn't appear to be the case today. I think the aspect that is something that is mindful to be mindful of, if we see a downtick in the economy, let's say joblessness rises, let's say we see some economic weakness, tax receipts will come down. And so already spending at a kind of relatively high deficit level, moving into a recession, you're probably looking at anywhere from 10+% fiscal deficit spends, which starts to become a bigger number. We do start having to talk about fiscal adjustments. But I think to some degree, if we looked at what would be a surprise this year, markets caring about the fiscal balance sheet in 2025. And I think future years, there's probably some hard discussions that need to be made, whether it's entitlement reform and others, but it's not a kind of quote near-term issue, let's say. Last piece that we wanted to focus on is the Federal Reserve. I think there's a lot of discussions about what is the role of the Fed? Will that change in terms of governance under President Trump? What's the status of Chairman Powell's job? He said it yesterday. He's not going to resign early. His term is up in May of 26, I believe it is. Yep. Do you have any thoughts on kind of the Fed's standpoint of are we likely to see much change from the Fed under a Trump administration versus what would have been a potential Harris administration?
Well, it's interesting that the Fed is intentionally meant to be apolitical, which obviously there are other factors that can come to play. Like we saw in Trump's previous term, there were a lot of tweets out there that mentioned the Fed. Yep. So that is a factor that can create some market noise that I think we have to acknowledge, whether it's real or not. The one thing that I think is interesting, we talked through all of these different aspects or policy potential implications for markets. On the margin, you think about all of these things, they are net probably a little bit inflationary over the next couple of years. So if you think that that is the case, that is directly related to the Fed's dual mandate. So if we do start to see inflation creep a little bit higher or even stay just a little bit stickier than the Fed's expecting, that could bias rates to the upside.
And it's less of a governance conflict of, is there meddling in terms of monetary policy? It becomes a policy conflict where you have executive branch, wanting pro-growth, pro-fiscal policies, and the Fed, do they need to push against that to manage inflation? And that's where maybe the rhetoric gets a little more intense in coming years. Should we see higher inflation? But maybe not an issue if we don't see inflation.
Yeah, exactly. And the president can't directly really deal with the chair. So for the most part, Powell's job is safe, but Trump does have the ability to replace some of the members of the Board of Governors. So he could, in some ways, kind of shape the voting members over the next few years. So that could be one way the Fed could become politicized, if you want to take that all the way through.
And there's some that argue the market's in control anyways, in terms of, how much authority does the Fed really have in terms of kind of managing policy, or is it really, the 2-year Treasury that runs everything? There's an old comment from James Carville, who is Bill Clinton's political strategist, and said when he dies, he wants to come back as the bond market because that's the most powerful force in the U.S. And so there's I think for us, it's less of an issue of what is the relationship between the Fed and the White House, and I think more of what's the relationship of spending to inflation, and that's a real focus kind of coming into next year. So we've got a couple questions here. I hope you can read them. But as we pull them up here, I think one of the things kind of wanted to talk about is kind of foreign policy questions. We didn't talk about that much, but thinking about some of the kind of foreign policy shifts, or maybe even just global election cycle that's still happening throughout the world, what are some things that come to mind that just be helpful for people kind of anecdotally, or just putting in context some of the changes we're likely to see in the next year?
Yeah, I think for anyone that's listened to a lot of our comments this year, geopolitics were top of mind. We saw plenty of election results where parties changed hands, and that informs the geopolitical landscape for next year. Trump historically has had more of a protectionist bias to a lot of his policies, and that's probably going to continue moving forward. When you think about what that means for some different trade agreements or some wars that are going on, it doesn't necessarily mean a whole lot for capital markets. Like I like to bring that back to what are the weight of these countries, or how impactful might this be for global economic activity? And there is not such a strong linkage between, let's say, Ukraine and capital markets. So that is one piece that I would just kind of be focused on when you're thinking about what will foreign policy mean.
Yep. And I think putting some of the other questions that we have here, we've seen kind of an uptick in treasury rates. Some of that's over the last kind of month or so. As we think about kind of treasury allocations or kind of safe haven allocations for our clients, how does kind of some of the maybe pro-cyclical policies in the Trump administration change your view, if at all? Or what are your thoughts on kind of a safe haven fixed income treasury allocation or conservative allocation that all clients sort of need in their portfolios?
Yeah, well, we have a view at NEPC, I could start out here, that all of our clients should have a quote safe haven bucket for liquidity purposes, for cash flow needs, and so forth. As of late, with the run up in rates that we've seen, I think it makes a whole lot of sense to us to make sure that that bucket is full with treasuries, just to ensure that we're getting the yield where we can in that safe liquid manner. So I think that backdrop and that allocation still makes sense to us. When you think about a lot of the policies that are being enacted, I don't think it changes that view in any way. Some of the pro-growth policies that are good for nominal growth, I think that maybe can change how we think about allocating within equities, for example, but not changing the entire structure of our portfolio.
Yep. And maybe just kind of wrap up here with the last question. We both can answer this. Of the themes that we mentioned under the new administration, what do you think is the most impactful? Short, long term, whatever it might be.
I think the regulatory backdrop one, and I'll give the really simple example of the liquefied natural gas executive order that Biden passed, that I think will be rolled back in pretty short order by Trump, which is really interesting when you consider the energy backdrop today, since prices are pretty suppressed and there's a global supply glut, and production's high in the US, and you can kind of talk about all these things, but that idea of America First policies, I think, is going to come through, and that whole deregulation wave will touch so many different industries, and I think it'll change a lot of how the country's operating at the moment.
Yeah, and I think in terms of my thoughts, I come back to trade policy, and this is maybe slightly longer term into 2026, maybe and beyond, of the tariffs at its core are probably really negotiating leverage. The Trump administration, the Trump advisors have talked a lot about bilateral trade agreements and kind of moving away from multinational agreements. And the tariffs are step one in that negotiation. And so over the next 3 or 4 years, we could see a pretty dramatic rewiring of global trade agreements. And I think one thing that's not really priced in by markets is some sort of grand bargain in terms of trade between China and the US. I think that would certainly be a surprise, and I guess to some degree be a surprise to us, but also it's one of those things, markets not pricing it in, and providing certainty both from an economic standpoint and just how goods move between the two countries probably is a positive for the markets over the long term. So with that, we're going to wrap. We're going to be conscious of everyone's time on a Friday. Usually Fridays aren't the best time slots for webinars, but we appreciate everyone joining us today. This will be posted on our website for anyone that wants to look back at it or share it with others. Also, we will have a dozen or so slides that have reference to many things that we talked about, that feel free to use as collateral when you're talking with kind of your boards and your committees and your advisors. And with that, hope everyone has a great long weekend. Veterans Day weekend, Veterans Day is on Monday. So with that, take care. Thank you, everybody.
Thank you.